I'm staring at a number right now that should not exist. Not in this market. Not at this point in the cycle. Not with everything the mainstream financial press has been feeding you about where silver is headed. The number is $10. $10 is the gap between what Shanghai paid for physical silver today and what the Western spot price is showing you on your screen right now. And here's what makes that gap not just interesting but actually alarming at a structural level. Western volume during the entire Shanghai session was nearly dead silent. Low volume on one side of the world, a $10 physical premium on the other side. That specific combination does not happen by accident. It happens when two completely different realities are operating at the same time inside the same market, and the pressure building between them has been quietly looking for a release valve for weeks. My name is OG John AG. If you're here for the first time, this channel exists for one purpose: to read the actual data, present both sides of the picture honestly, and let the facts carry the weight without all the noise that passes for financial analysis everywhere else. If that's the kind of content you want consistent access to, hit subscribe. That's all I'll say about it. Now let's get into exactly what's happening and why the data is telling a story that is not showing up anywhere in mainstream coverage right now. Shanghai vs. Western spot divergence. Shanghai silver futures opened this morning at $99 per ounce. Not $89, not $92, not some number that fits neatly into the Western narrative about where silver belongs. $99. Western spot heading into that open was sitting at $88.50. So before a single trade even printed on the Shanghai Futures Exchange floor today, the physical demand signal out of Shenzhen recyclers that we tracked carefully in the last video had already told you precisely where this session was headed. Bids in Shenzhen were running $5 or more above the SHFE pre-holiday close. That wasn't a rumor floating around on some forum. That wasn't speculation. That was the physical market pricing real-world demand before the exchange even turned its lights on for the session. Shanghai opened at $99, pushed all the way up to $102, and closed the session at $96. And before you just process those three numbers in sequence and move on, here's the detail that completely changes how you read all of them. The final physical lot of the session reportedly cleared at $102. The session average was $96. Whether you anchor to the average or to the final transaction as the more accurate reflection of true physical demand is a legitimate debate among serious market participants. Reasonable people can look at the same session data and weight those two figures differently, but both numbers share one critical characteristic. Both of them are substantially above Western spot by a meaningful amount. That's the part that matters regardless of which figure you choose to focus on. Right now, Western spot is sitting at $86.40. Shanghai's session close was $96. The final physical lot cleared at $102. That is a $10 premium at the session average. That is a $15.60 premium at the final transaction price. And Western volume during all of this, during an entire Shanghai session that opened at $99 and hit $100, was, in the words of multiple people tracking it live, almost completely stalled. You do not get that specific combination. Low Western volume, heavy physical premiums, pre-market bids running $5 above the prior close without a structural reason sitting underneath it. This is not noise in the data. This is the data communicating something with unusual clarity. The question is whether you're positioned to read it without the distortions that come from wanting it to say something specific. Hold that $10 gap in your mind, because every layer of historical volatility in options pricing, this analysis connects back to it. Let's move to the options market, because what it's currently pricing represents one of the most striking disconnects in this entire picture. The COMEX implied volatility index for silver options is now at 134. When we covered this metric in the last video, it had just broken above 100. And that reading alone was already elevated enough to warrant serious attention. 134 is not elevated. 134 is historic. To understand exactly why that number is significant, you need one reference point. January 30th, the session when silver spiked to $120 per ounce, one of the most violent upside moves the metal has experienced in recent memory. The implied volatility reading during that event was lower than where it sits today. Read that carefully. The options market is currently pricing in a higher probability of violent, potentially disorderly price movement than it assigned during an active spike all the way to $120. Both the SLV volatility index and silver futures options implied volatility are pointing in the same direction simultaneously. Sharp upside price risk. The spot price is suppressed at $86.40. The volatility index is at a multi-month extreme. Those two conditions cannot coexist indefinitely without one of them giving way. Either the volatility index corrects sharply downward, meaning the market stops pricing an explosive movement, or the price corrects sharply upward to reflect what the options market is already discounting. One of those two things happens. Both cannot remain true at the same time. In a moment, I'm going to walk through the settlement data in detail because that's where the most specific and most time-sensitive pressure is concentrated right now. But before we get there, something happened on the SHFE today that adds a layer to this picture that deserves its own focused attention. The SHFE manipulations and account suspensions. The Shanghai Futures Exchange suspended another group of accounts today for breaching trading rules. This is not a continuation of a story that began last week. This is not a periodic enforcement action that happens on a predictable schedule. That action today brings the total number of accounts suspended on the SHFE in February alone to 23 suspensions inside a single calendar month. And the specific context around today's suspensions matters just as much as the number itself. What was observable at the SHFE open this morning, visible in the order flow, documented and flagged in real time by people actively tracking market structure, were heavy manipulation attempts at the open. The exchange responded by suspending the accounts responsible for that activity. Sit with what that actually means. The exchange itself, through its own enforcement mechanism, confirmed that the manipulation attempt was real enough, documented enough, and severe enough to warrant regulatory action. This is not a narrative being constructed after the fact. This is the exchange's own public record, verifiable through their suspension notices. 23 accounts suspended in February. Pull the SHFE historical enforcement data and compare that figure to prior months. The February number is not normal. It is an outlier, and it is telling you something about the level of activity currently concentrated around silver price at this particular moment in the cycle. The COMEX settlement and physical imbalance. Now let's go to settlement, because this is where the structural pressure becomes most concrete and the timeline becomes most specific. March open interest as of Monday stands at 37,651 contracts. Each contract represents 5,000 ounces of silver. That is 188 million ounces of paper silver moving towards settlement in 3 trading days. On the other side of that equation sits registered COMEX silver, the metal that is warrant issued, physically located in an approved vault, and actually available for delivery against a futures contract. That number sits at approximately 88 million ounces, 2 to 1. For every single ounce of deliverable physical silver currently sitting in COMEX vaults, there are 2 ounces of paper contracts demanding settlement. The roll is already underway. May open interest has jumped significantly as long positions move out of March and further down the curve, but the roll is not complete. Not by the margin that would eliminate delivery pressure entirely. February 26th is the last safe day to roll a March futures position. If avoiding physical delivery risk is the objective, February 27th is first notice day. From that point forward, shorts have the ability to begin issuing delivery notices, and any long position still carrying March contracts past that date becomes eligible for physical assignment. This is not a soft deadline. This is a structural hard stop with a specific date attached to it, and that date is 72 hours from now. Pull up the CME open interest data right now while this video is playing. Look at the March contract specifically. Look at the pace of the roll relative to where it needs to be by February 26th, because what that data shows about the current pace of position movement should completely recalibrate how you're reading the spot price suppression at $86.40. Here is what sharpens the settlement picture beyond the headline numbers. Registered silver in COMEX vaults has remained essentially flat to slightly declining over recent days. No meaningful new metal is flowing into the registered category from eligible storage. The drain is continuing. The buffer is not being rebuilt. 188 million ounces of paper, 88 million ounces of deliverable physical, a hard deadline arriving in 72 hours, and no new metal entering the system to close that gap from the supply side. When you place those 4 facts side by side, the question is not whether pressure exists. The question is how it resolves and on what timeline. Understanding backwardation and market structure, there is one additional variable inside the settlement picture that a smaller group of informed participants is tracking with significant focus right now, and it has not broken into mainstream market commentary. The carry-adjusted basis between March and May futures in a normally functioning futures market. Contracts with later delivery dates trade at a premium to nearby contracts. You pay more for silver in May than in March, because May delivery incorporates additional financing costs and storage costs across the intervening period. That structure is called contango. It is the baseline condition for a healthy commodity futures market. When that structure inverts, when the nearby contract trades at a premium to the forward contract, the market has entered backwardation. And backwardation in a physical commodity market sends exactly one signal. It says, I do not care what the paper price is showing. I need physical silver today, and I'm willing to pay a premium for immediate delivery rather than accepting a lower price for a promise to deliver later. We are not in confirmed backwardation on the March-May spread yet, but the basis is approaching that threshold. If it crosses, this is not a matter of interpretation or perspective. It's a matter of market structure shifting in a way that changes the conversation around physical availability entirely. Keep the CME basis data open. Watch the March-May spread specifically. That potential flip is the signal that the informed minority is positioned around right now. Macro drivers, crude oil, and Eastern demand. Now step back from the COMEX entirely for a moment, because there are macro inputs converging on this picture from multiple directions at the same time, and any single one of them would be significant in isolation. Together they form a backdrop that the current paper price at $86.40 is not reflecting in any meaningful way. Crude oil has moved to $67, the highest level seen since August. Bullish positioning on oil is surging across multiple timeframes. The question being asked in serious commodity circles right now is whether this positioning is being built ahead of a potential Iran escalation scenario that has not yet materialized in headline news. But layered directly underneath the geopolitical premium is a structural supply reality that does not resolve on any near-term timeline regardless of geopolitical outcomes. Global oil discoveries have declined by 40% over the past decade. Between 2015 and 2020, the world was discovering an average of 10 billion barrels of new oil per year. Between 2021 and 2025, that figure dropped to 6 billion barrels per year. That is not a rounding error. That is a structural supply deterioration with a minimum 20-year lag before new exploration activity produces first output at scale. When crude moves simultaneously on both geopolitical risk premium and long-duration structural supply concerns, it injects a persistent inflationary input into the same macro environment that is already driving institutional and sovereign capital into gold and silver. These are not independent signals operating in separate rooms. They are reinforcing inputs moving in the same direction across the same macro backdrop. India just confirmed another record month for gold imports. Not a strong month, not a recovery from prior weakness, a record. That is not an isolated data point you can set aside. It is the continuation of a pattern that has been running at historically elevated levels for months, and it is consistent with what the broader Eastern physical demand picture has been showing consistently across the same period. And then there is the gold price itself, which mainstream financial analysts are still struggling to explain in any coherent framework. Spot gold is currently trading at $5,130. The mainstream press has cycled through several explanations: momentum, speculative excess, technical breakout, safe haven flows from geopolitical uncertainty. What these explanations consistently fail to incorporate is the actual flow data, the World Gold Council data, the Indian import numbers, the Chinese ETF inflow data, the BIA settlement reporting. Anyone who verifies these figures rather than defaulting to mainstream commentary understands exactly what the capital flows are communicating. Institutions and sovereign buyers across Asia are making a deliberate, systematic, and quiet judgment about where real value resides in a global monetary system that is being restructured in real time. They are not doing this loudly. They are not announcing it in press releases. They are doing it consistently at scale, session after session, month after month. The capital is moving. The mainstream narrative is still searching for an explanation that fits its existing worldview. There is a profound difference between those two activities, and understanding that difference is what separates the minority who are positioned correctly from the majority who will only understand what happened after it is already completely finished. The case for caution and volatility risks. Now, the honest case for caution, and this section is not a formality. It's here because reading the data honestly means reading all of it, including the parts that complicate the straightforward bullish narrative. Look at what actually happened inside today's Shanghai session. Silver opened at $99, pushed to $102, and then closed at $96. It did not hold $100. It did not close above the open. The session showed genuine selling pressure above the $100 level. Not just manipulation, but real market participants willing to take profits and reduce exposure at those prices. That is not a footnote to dismiss. That is the market giving you honest, unambiguous information about where supply and demand are currently balanced at the upper end of the range. The implied volatility reading of 134 cuts in both directions with equal force. The same structural potential that implies violent upside movement can produce equally violent downside moves if the wrong combination of variables triggers at the same time. A coordinated intervention from a major counterparty, a margin call cascade across leveraged positions, a broader risk-off event that forces selling across multiple asset classes simultaneously. Any of these scenarios could compress price sharply and rapidly from current levels. The volatility is real. The direction it resolves is not predetermined, and treating it as such is how serious capital gets destroyed in markets that are as structurally compressed as this one currently is. Furthermore, the existence of a $10 premium between Shanghai and Western spot does not automatically mean Western prices close the gap by moving upward. That premium could also narrow from the Shanghai side if subsequent sessions show that today's physical demand signals were not sustained at the same intensity. Humphrey Neal wrote in Tape Reading and Market Tactics that the tape tells you what is happening, not when it finishes happening, and not in which direction the final resolution falls. The structural story is written in the data. The timeline and direction of resolution belong entirely to the market operating on its own schedule, completely indifferent to how any observer wants the picture to unfold. Carry that balance with you as the full picture comes together. Synthesizing the data. A structural crisis. Here's what the data is actually saying in aggregate right now. Shanghai closed at $96 with the final physical lot of the session clearing at $102, generating a minimum $10 premium to Western spot at $86.40. COMEX implied volatility is at 134, exceeding the readings recorded during the January 30th spike to $120, the most violent upside move silver has experienced in recent memory. 188 million ounces of paper silver are heading into settlement in 3 trading days against 88 million ounces of registered deliverable physical, a 2-to-1 paper-to-physical imbalance at the moment of maximum settlement pressure. No new metal is entering COMEX vaults to replenish the registered category while the drain continues. The March-May basis is approaching a potential backwardation threshold that the informed minority is watching with focused, specific attention. India is printing record gold imports. The ESHFE has suspended 23 accounts for manipulation in a single month, with the exchange itself confirming manipulation attempts at today's open through its own enforcement action. Crude oil sits at its highest level since August on simultaneous geopolitical and structural supply pressure, and Western spot is sitting at $86.40 below a resistance zone between $8,720 and $89 that has now rejected price 3 separate times without producing a single displaced violent hourly body close above it. 3 rejections, no decisive break. Not a wick. A body close above $89 on the hourly chart is the threshold that changes the technical picture. Until that prints, the zone is doing exactly what resistance zones do. 2 markets, 2 prices, 1 structural pressure that has been building visibly in the data for weeks. Jim Rickards described this specific type of stress in currency wars as the moment when financial warfare becomes visible, when the paper construct that normally manages price perception begins to crack under the weight of real-world demand that it cannot indefinitely contain. That description is not a theoretical framework being applied to a hypothetical scenario. It is a precise description of what is currently observable in the data in real time between a Shanghai session close at $96 and a Western paper price sitting at $86.40. The gap resolves. Markets always resolve their structural contradictions. The only open variable is when and from which direction the resolution arrives. What is not open to debate is the direction of the structural pressure. The data is not ambiguous on that point. But the timeline is set by the market itself, and the market operates on its own schedule with complete indifference to the expectations of anyone watching from outside. Conclusion: paper price versus reality. The discipline required in this specific environment is the ability to read what the data is actually saying, separate it clearly and deliberately from what you want it to say, and manage your position and your emotions with equal precision. That distinction between reading the data and reading your own bias through the data is where most participants lose capital, not because they found the wrong information, but because they filtered correct information through the wrong lens and called the result analysis. Verify the CME Vault reports. Pull the open interest data and look at the roll pace yourself. Check the SHFE enforcement record for February. Watch the March-May basis on the CME data portal. Every number cited in this video is public, specific, and verifiable. The structural story does not require you to take anyone's word for it. It requires attention and the willingness to read what's there, rather than what's comfortable. Here's the question this data leaves you with. The one I want you to hold after this video is over. If the paper market and the physical market are simultaneously pricing silver at 2 different numbers separated by $10, while Western volume is too light and too slow to close that gap on its own, what exactly is the Western paper price measuring right now? Is it measuring silver, or is it measuring something else entirely, and just attaching silver's name to it? That question does not have a comfortable answer, but it is the right question. And the ones asking it clearly, without letting either fear or excitement distort the reading, are the ones who will understand what this moment meant when it's visible in hindsight. If you stayed with this video all the way through the bullish case, the bearish case, and everything in between, drop OG John AG 2.0 in the comments. Not as a ritual, as a signal to yourself that you're here for the full picture, not just the part that confirms what you already believe. That discipline is rarer than most people realize. If this analysis gave you something real, put it in front of someone who's asking the right questions but hasn't found the right data yet. The channel grows one serious viewer at a time. That's the only growth that matters here. Invest with logic, never with hype. OG John AG, signing out. The data doesn't lie, but bias always does.